Hello, I'm Brent Bloomer, Director of Advice Solutions here at Caliber. I hope you're having a great summer so far and wanted to take a couple minutes to provide a quick mid-year market update from all of us at Caliber, recapping what happened in the second quarter and sharing what we're watching as we head into the second half of 2025. Let's start with the second quarter, which was anything but ordinary. Volatility was high and markets saw big swings in both directions. The drama kicked off in early April with Liberation Day, when the U.S. announced a flat 10% tariff and much steeper reciprocal tariffs on global trade partners. That announcement triggered a sharp sell-off in the U.S. markets, with concerns about inflation and economic slowdown rattling investors. From April 2nd to April 9th, the S&P dropped nearly 12%, hitting a low of down 15% during that week, and hit a low for the year being off 21% from February highs. But the turnaround was just as fast. On April 9th, a midday announcement paused the implementation of these reciprocal tariffs for 90 days. That sparked a rally that carried through the rest of the quarter. And actually, by the end of June, the S&P had not only recovered, it was up 11% for the quarter. Tech stocks led the rebound after a weak Q1, but nearly every major asset class participated in the rally, with the exception of commodities. International stocks continued their strong run, up over 20% year to date, and bonds also delivered solid returns, building on a bounce-back year in 2024. We noted back in April that historically, time in the market has typically yielded better results than trying to time the market, and once again that held true. Those who stayed the course were rewarded. While the tariff situation certainly isn't fully resolved, we're cautiously optimistic the worst may be behind us. The U.S. has made progress on deals, specifically with China and the U.K., and more agreements with other partners are expected in the near future, but time will tell. Later in the quarter, attention shifted to growing geopolitical tensions, particularly between Israel and Iran. While it was a serious escalation, cooler heads appear to have prevailed for now, and the direct market impact was limited, outside of a short-lived spike in oil prices. So we look ahead to Q3, we're hoping for a normal environment, if such a thing exists these days. That said, here are a few key things we're keeping an eye on. The first is inflation. Despite fears, the flat 10% tariff hasn't pushed inflation higher, at least not yet. In fact, inflation came down in Q2 compared to Q1, thanks in large part to the falling energy prices. But the real test will be what happens when or if the pause on reciprocal tariff ends as soon as later this month. The quicker deals are signed, the clearer the inflation picture becomes. On the policy front, the recently passed One Big Beautiful Bill extended and even enhanced tax cuts from the previous Trump presidency. We believe this is generally positive for markets, though the unknown long-term costs and their potential inflationary impact are worth watching. Next are interest rates and the Federal Reserve. The Fed continues to walk a tightrope, balancing inflation control with supporting employment and growth. Inflation is trending in the right direction, as mentioned above, but still above their 2% target. The labor market remains healthy, though there are early signs of slowing. Hiring has cooled slightly, but unemployment is still in the low 4% range, wages are growing, and large layoffs remain limited. The Fed is also watching the tariff situation closely. They don't want to cut rates only to see tariffs reignite inflation. As of now, they're projecting 2 rate cuts, likely 0.25% each, by the end of the year. If inflation continues to cool and/or job growth softens, we could see those cuts sooner rather than later, which would help ease borrowing costs for both consumers and businesses and offer a potential boost to the economy. We'll continue monitoring all of this closely and keep you informed as things evolve. In the meantime, we hope you enjoy the rest of your summer, and as always, please don't hesitate to reach out to your advisor if you have any questions or would like to talk more about your plan. Thanks for your continued trust and partnership.